started. Well, hello and welcome to this afternoon's webinar, Essential Investing for You and Your Loved Ones in 2026, led by Raymond A. Rondeau. Thank you so much for joining us. We're happy to have you all here. So my name is Jenna Brashear and I will be your host for today. And I'd like to go over a few things before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give any personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And today's presentation will include several interactive quizzes. To join in, simply type your answers in the question section of your GoToWebinar control panel when prompted. We will announce our winners at the end of the presentation, who will receive a special prize. And then if you have any questions for our speaker during the presentation, please submit them using the same question section of your GoToWebinar control panel. And then once our presentation concludes, John will select a few questions for Ray to answer. And then if your questions aren't selected during the broadcast, feel free to email us at members@aaii.com. And a handout of the presentation slides will be emailed to all attendees later this week. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available on aaii.com/webinars, as well as our YouTube channel, along with links to this presentation's handouts and any helpful resources that we discussed today. And then for new viewers, we always like to give a little background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And in this presentation, Ray will cover a few things such as the qualities that contribute to long-term investment success, key factors to consider when choosing stocks, and evidence-backed strategies to boost your performance, simple, effective techniques to manage risk across all types of investments, ensuring your portfolio is protected from market volatility. And then we have a special holiday offer for today's attendees, so please stay tuned for the details. We'll be sharing our exclusive discount on the EEI course, and then our BOGO deal later, buy one, get one, during this event. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jenna. My name is John Bykowski. I'm the president of the American Association of Individual Investors. And I've got the pleasure today of introducing our speaker, Raymond Rondeau. He's truly a star here at the association. He is able to elevate the investment IQ of our members with his information, his informative presentations, all the work he does. I mean, he really brings has the rare ability to combine his deep passion and knowledge of investing into actionable insights for our individual investors. So I want to keep this introduction short. I know Ray has a lot of wonderful information to present to our people. I'm going to fade into the background. I'll be listening to questions you might pose in the Q&A area. But with that, please, Raymond, take it away.
Okay, well, thank you, John. Thank you for all that. And we shall see how we do today. So welcome to today's presentation. We titled this presentation, Essential Investing for You and Your Loved Ones in 2026. And as reference in the promotion for this event, we're going to take a kind of a, so you think you know investing, prove it, kind of a fun approach with this. To keep this presentation interesting, we'll have a little bit of investing humor, some content-related investing quotes, and quite a few interactive segments where you can win a free investment class from our entire video education library. And that's any class you want from any of our instructors. To win, simply be the first person to type the correct answer in the chat area when we come to a quiz. I'll ask you the question, and then you can type in your answer. You can only win once, okay? And you can only get one guess per question. Jenna will be our judge, jury, and executioner. And although she may look innocent, she can be ruthless if she has to be. So Jenna will announce the winners at the end, and we'll email you a link to get your free class if you're a winner. And again, that's any class in the library, and some of the classes go for $100 or more. I always start and end with a quote, as many of you may know. Benjamin Franklin once stated, an investment in knowledge pays the best interest, which plays on a double entendre, best interest, and for our purpose, it's obviously going to be investing interest. The primary theme of this presentation is the importance of investment education and how it can make such a dramatic difference in the quality of your life and perhaps those of your loved ones. That's why we have the BOGO offer. Because of this, we're going to have that buy one, get one free offer. And you can either buy one for yourself and give one to somebody else, or you can just buy it and give it to 2 people. If you take advantage of this offer, we'll send the recipient a holiday gift email around December 20th, notifying that the gift is from you. And this includes AAI membership. And this offer centers around AAI's Essential Investing course, which has been out a couple years now. So I am going to tell you a little bit about the course, and then 98%, the entire rest of the presentation is all focusing on techniques and strategies from the course that you can use without the course. A little bit about the course, as you can see it here in this video, and attaining AAII certification. The course currently has 18 classes and over 12 hours of material. The classes in the course are not simple recordings or a single instructor standing in front of a camera, or the repackaging of a webinar like I'm doing right now, like so many other educational products being offered. The classes are professionally produced, full-featured, interactive, multi-camera, studio-grade audio engineered recordings, and they focus on essential investing principles and strategies, many of which we'll cover here today. The course is housed in a professional learning management system, the gold standard for online learning. The course contains dozens of instruction or navigational documents and videos if you have questions. The course includes an exam, and if you pass the exam, EI course certified participants will receive a certificate of completion and an extensive list of AAII course certification benefits. The primary educational content, the videos are featured in Scorum formatted. They have jump to table of content. You can search keywords throughout the video. There's ongoing self-assess quizzes, interactive hyperlinks to external content, the ADA, closed caption compliant, etc. You get the idea. This video shows you what's in each individual class, and it really is extensive. Here you can see on the snapshot page, this is a tab for each class. We give you a lot of preliminary information about the course, how long it is, etc. Then we give you information about the speaker or the instructors. Many instructors will reply to your questions if you have them. From there, we give you preliminary learning materials. Right here, we have key terms that you should be familiar with before taking it. We also give you all the slides. And then in this section, we also give you some preliminary articles that the instructor recommends before you take the actual class. This is the class right here, and we talked a little bit about the videos. Very extensive and interactive. Once you finish the class, you will be given the test, which you can see there. And when you pass the test, you have unlimited times to pass it. Often you'll get bonus videos, words of wisdom segment, and even a segment incentive bonus where many of the instructors give you something for passing their class. And then you get a certificate with each class for passing it. And then if you pass the course, you also get a certificate for that with another host of benefits. Then following that, we give you additional articles and links. Many of the classes have tools that you'll get for free, which I'll talk about. We have a survey, and we even have a chat and discussion area where you can post questions and a help section. That gives you a little idea about the course. And again, all them benefits are in each class. We give you a full year to complete the EI course. If you need longer, just contact us. And it even includes a 60-day money-back guarantee. And the course took us, it is true, almost 5 years for us to complete this. As importantly, this course is not static. We're going to be releasing more already recorded classes in the future. We have Systems and Forecasts and MACD fame, Marvin Appel, Louis Navalier. It has a class coming out on how to pick winning stocks, and Marty Fritzen has almost a 2-hour class on fixed income investing. If you those don't know, Marty is the youngest person ever elected to the Fixed Income Hall of Fame. So we're proud of this course. The last area I will touch on is related to the course. We won't spend a lot of time on it today, but for some people, this would be the primary driver just to get the EI course. Included with the course, no extra fees, are AAI's active investing tools. These should be released sometimes in the next few months. Again, they're free, included with the course, and you can keep them for life. You can see a preview of some of these tools on the screen here. These are cutting-edge tools for execution assistance, position and portfolio monitoring, risk control, stock scanning, technical-based timings, and complete buy-sell strategies with full performance reports at the click of the button, which you're seeing right here. You can see this. You can see each past trade for each strategy on any stock that you want. Some of these tools are so advanced they'll literally even talk to you by name. So if you're interested, you can go to www.aai.com/veseducation/holiday for more information. And at the very end, we'll tell you how to give this gift for a loved one, or you can give it to 2 people if that's your choice. Again, aai.com veseducation/holiday, which is a perfect segue to the first of the 3 investment areas that we're going to look at today, as this presentation is based on material from the first 2 classes in the EI course. They're called the Building Wealth Through Investing. So we're going to see right now if we can make a difference in somebody's life, a positive difference, maybe over the next 35 minutes or so, and we're going to have a little fun doing it. So to start with the fun, we have our first quiz. And yes, we changed the questions from similar presentations on this material, just so you know. So first question, type it in. You can get a free VES class, anybody you want. What was the website URL for the EI course offer that I just showed you? You can type it in. First person to type it in. Doesn't have to be perfect. We'll accept syntax errors. Again, Jenna's in charge here. It's all in fun. I'll give you a little clue. That was part of it right there. WAI.com/VES something/something. I want to spend a lot of time on this. Jenna, I'm assuming that we have somebody close enough to declare a winner before we move on. And again, we'll announce all the winners at the end and how you can get it. So here's the answer right here. It was www.ai.com/VES education/holiday. Just want to make sure everybody's on their toes. Okay, that's it. Everything else is strategies and techniques. Essential investing in 2026. Of course, we're assuming or we're implying that you're already investing, which is not always the case, and we realize that. So that's where we're going to start. Why should I invest? Can I be successful? What does it take to be a successful investor? And how do I put myself in the best position possible to maximize or improve in performance? We're going to start with a story here, and I've covered this story before, but it's a true story, and the underlying concept of this story is not novel. For years, I've been part of and oversaw an advanced group of investors and traders that met regularly at MIT. And as you can imagine, it was a very competitive environment, and we like to encourage and challenge each other. So about 20 years ago, we had a graduating student propose a challenge to the group. We'll refer to him as Shane. We changed the name to protect the innocent. Actually, we didn't. His name really was Shane. So Shane was going to become a dad, and he wanted the following for his son. He wanted to legacy $1 million to his son at his son's retirement. He wanted to do this by investing. He had no money to invest. He didn't want to do any additional work or effort to attain this goal, and he wanted to live the same lifestyle with no sacrifices. So with his desire, to bequeath $1 million with nothing to invest, it was challenging, and it made a valuable study to the group. And from this study, we generated a lot of important investment, what we call revelations, keys to being a successful investor. And that's what I'm going to share with you. So after debate and deliberations, we agreed on somewhat of a theoretical compromise. We said we needed some money to start the investment process. So we looked and settled on $2.76 a day. The price of 2 bottles of water, there was a story with that. So 2 things here. Again, this is not a new concept. And 2, I know that we said Shane did not want to sacrifice anything, and he won't. We're going to remedy that at the end. But this is how the group and what they originally went with. So here's the proposal. We proposed that Shane will invest $83 a month, only for the first 18 years of his son's life. So how much would Shane have to bequeath his son? Well, we're missing a key piece of information, right? You can't answer this. What are we missing? We're missing the anticipated percentage return of the investment. So in this table, we have some statistics on historical percentage returns of U.S. stocks in various asset classes. This table from Paul Merriman does an excellent presentation in one of the VES classes, and this table is taken from it. Now, we didn't take Paul's findings of 14.4% on small cap value. We just went with a nice round middle of the road historical average number of 11% for equities. With a long-term time horizon of 70 years, 100% equity exposure seemed reasonable throughout most of the duration. So here's the question again. Normally we would do a quiz here, but I have a feeling that many of you have already seen this example before we get to new material, so we're not going to do a quiz on this one. What do you think? How much money would Shane accumulate after investing $1,000 per year with a return of 11% after 18 years? Well, get ready to be disappointed. After the first 18 years, the final balance with the $18,000 worth of contributions comes out to only $53,000. Not very good, is it? No. But before you turn off your computer, according to the plan, Shane does not add another penny now and simply lets it ride. And now we will do another quiz for a class. And this one kind of rewards our determined members who may have seen this portion of the presentation in the past, but are still watching, so you will have an advantage here. How much would Shane have to bequeath his son, presumably in a trust, now when his son turns 70? Type your answer in for a free VES class, and whoever comes closest to the exact dollar amount will win. So now he's holding it for 70 years at 11%. And all we did was put $18,000 in over the first 18 years. Okay. So what was the goal? The answer comes out to over $12 million. In today's value dollars, to Shane's son at his son's retirement, all for sacrificing a couple of bottles of water each day, again, just for the first 18 years of Shane's life. Now, of course, this is purely hypothetical, right? We're not trying to fool anybody here. First, we're assuming historical returns, which is all we have. We have to base an assumption on something, but we're leaving out some major factors that we're going to address here. Commissions and fees, well, they're becoming a thing of the past, but they are critical. I will show you this in a little bit. Stunningly critical. Slippage, this is an underrated loss that we will cover in the next section. I'm going to give you some ideas how to deal with this. Taxes are not minimum, but there are strategies to reduce their effect. And we have a segment in a VES class by our own Charles Rothblatt to address that one. And inflation. Inflation will significantly reduce the true value, but we're going to consider that with our investment selections. And I would say this is the most critical part of this presentation, which comes up in the end of this section. I'm going to show you some information that may surprise you about linear relationships. After several months of meeting on this, there were several repeated lessons, or again, we call these revelations, that kept coming up for building long-term wealth through investing. And these were from the group's experience in their rather extensive research on this topic and strategy design. To put this in perspective, there was an estimated 700 plus years of combined knowledge from a high-profile group of full-time investors, professional traders, and educators on trading and investing. And in the remaining parts of this section, we're going to look at a portion of these, 16 revelations for creating wealth through investing. Good. Revelation 1, you knew this was coming, right? Have a plan. The group believed with a thorough, reasonable, and attainable plan that investors would be more likely to achieve their goals and to get where they wanted to go. It seemed that successful investors had a plan, and with a plan, it reduced the tendency to act emotionally and subsequently chase returns, buying high, and then liquidating investments during major sell-offs and unfortunately selling low. It was believed that investors who had a plan seemed to stay focused and in wise mind, where they like all of us, make better decisions. Revelation 2, an investor had to accept that variables and uncertainties in the market exist and that no plan is perfect. I agree. We don't know what the future historical stock market returns are going to be, but to design a strategy or strategies, we need to make assumptions and projections based on the best information that we have to be able to control what we can and accept what we can't. And I think most would agree that having an investment plan that is not perfect or foolproof, several things are in life and we still do them, is certainly better than having no plan at all. Revelation 3, there is or was no single best plan or strategy for every person in every situation. In reading some of the AAII chats, some people may not agree with this and everybody thinks they have the best solution. With this revelation, the group believed that an individual's ultimate approach in their selected best investment strategies had to be based on and in line with their own personal situation. And you can see some of these factors listed here. And the group believed that an investor also must realize, as importantly, as that these will change throughout one's lifetime. The importance of education and the ability to adapt as the markets and one's life circumstances changes. Put another way, the right way to invest in the right strategy is really the one that's right for you, not me or someone else. Revelation 4, don't be afraid to think out of the box with alternate solutions. In Shane's case, everyone came up with different ways to invest and with different ways to accumulate the funds to invest. Part of the reason this challenge started was a debate over a bottle of water. People at MIT will debate about anything, trust me. For many people in their group, their big life change was purchasing a $150 distiller or a home water filtration system, as opposed to spending $1.50 for filtered water from some big city's public municipal water supply, in which, at least for the two biggest bottled water suppliers in the US, that is true, that's what it is. The group reasoned that it was cheaper, they didn't have to lug it, and it was better for the environment and, of course, their finances, which is our primary focus. But Shane thinks out of the box here, or out of the bottle in this case. His solution choice was, instead of paying for cash or using a debit card for regular purchases, which he was doing at the time, he started using a credit card with a 2% reward on all of his purchases. And the card he chose automatically transferred the rewards directly into his brokerage account for investments. And these cards still exist today. And at the end of this section, I'm going to show you how Shane expands this approach to attain 7%. But for now, at 2% with this approach, he had no change in lifestyle, he did not require any additional effort, and now it meets our criteria. At the time of study, the US budget statistics showed expenses for the average family were around $53,000 a year, and this was more than enough to get him to his target of $2.76 a day with this strategy. The key word here is directly, as this strategy transferred money to his account, leading us to Revelation 5, and you knew this was coming, voted on as the single most important aspect of being a successful investor: discipline. For this strategy to be effective, Shane had to actually invest the reward money and pay the credit card each month in full, right? The best investment plans and strategies in the world won't work if an investor doesn't follow them. In fact, it's routinely found in hindsight that the reason most investors fail is not because failure of the strategy, but because the person failed to follow the strategy. In fact, a 2022 study by Dalbaz showed that over the previous 30-year period, the S&P 500 average return was 9.65%, while the average equity mutual fund investors' return was only 6.81%. Now, there could be many reasons for this, but certainly one of them could be the fact that emotions cause many investors, presumably without a plan, to chase price and uptrends and then panic selling downtrends, not having or showing discipline. Revelation 6, good investors don't fear technology. And those that don't want to use it directly, they're open to at least using the information derived to it from their advantage. On this video, you can see the program that I use for testing factors into developing technical-based investment strategies. We're going to look at one of these strategies in a few minutes, and you can use this strategy free. With this technology, we can generate hundreds of fields of information on hundreds of stocks over decades while testing a theory. Then we can use the program to optimize those factors and then look how to best synergize these factors to create a trading system or an investment strategy. Now, this isn't foolproof, and it isn't easy, as it often takes hundreds, if not thousands of lines of code in weeks and sometimes months to develop a good system. But research like this is invaluable, and technology can be used to help us. Kind of counter to this is Revelation 7, and many may find this good news. The group as a whole believed that investing plans and strategies did not necessarily have to be complex to be effective. And here I would definitely state, as a day trader for 20 years, day and swing trading, chart reading has a definite law of diminishing returns. The truth is that an investor can gain a large percentage of the benefit of chart reading while only knowing a small percentage of the technical theory that's out there. 4 or 5 key patterns, maybe 2 or 3 indicators is the most investors will ever need. And these are all covered in the course. It doesn't have to be overly complex. You don't need to know everything. Just learn a little bit and it can make a real difference. I'm going to give you a couple examples of simple strategies for mutual fund investors, kind of just get us warmed up. In this table, we can see the results from a study published in Stocks and Commodities magazine in 2023 on the average returns of each day of the week in the S&P 500 from 1965 through June 2023. And as replicated by many, they showed that Mondays were the worst performing day of the week, with an accumulated average yearly return of a shocking minus 1.75%. Look at that difference, how the other days it grew. And it only gets worse for small caps, with the Russell coming in at minus 2.19% as measured from the year 2000. Again, look at that differential. Well, that's technical data. It gives us something to look at, but how might in a mutual fund or a fund investor or any investor use this? Well, for mutual fund investors, they could time their periodically weekly purchases on a Monday, getting lower relative entry prices. Another reasonable approach might be after a major sell-off in a previous REIT to consider refraining from reviewing your accounts on the weekend, getting sticker shock like everybody else, panicking, and then entering your fund redemption order, as these orders will be filled at Monday's historically lower prices, especially in this situation. There are reasons that Mondays tend to be lower. At least according to the statistics, you'd be better off waiting for turnaround Tuesday and getting probable higher prices if you still want out. A simple approach, right? Based on data and research. Here's another one. It's been believed and it's been measured that the last day of the month and the first days of the month are the best performing days in the stock market. The Journal of Wealth Management published a study reinforcing this phenomenon. So for those who dollar cost average for purchases into mutual funds on a monthly basis now, perhaps they should consider not transacting at this time like most investors. Their research suggested purchasing on the 23rd of each month. And if you're doing periodic redemptions, then you would look to do so on the first of each month, using the investment knowledge to our advantage. Revelation 8, intellectual-based investment research approaches and strategies seem to be more effective, bringing it back to my viewpoint. This is a pillar of AAII, evidence-backed research, right? We just touched on this. Here it was believed that for no other reason, if an investor believes in and understands a strategy and is evidence supporting the strategy's effectiveness, that they were more likely to follow them. And in this case, with our little cartoon here, refrain from jumping, right? Because we've all been there in difficult times of investing. In the EI course, Wayne Thorpe has 3 classes on stock investing, and one of these classes focuses on an important factor when using a fundamental stock investing approach. And I know a lot of our AI members use fundamental analysis. In fact, one fundamental stock factor or measurement that's covered in the course was so relevant that the co-authors of the paper won a Nobel Prize. You may have heard of them, Farmer and French. What they did was they showed in a study from 1963 to 1990 that stocks with the lowest price to book value ratio outperformed those with the highest by over 13% per year. It's this type of research and these type of factors that we use to develop many of AI's fundamental stock screens in which they're based on. Again, it's based on research. Revelation 9, when considering any investment strategy, it's good for an investor to be skeptical and to be sure what they are looking at is accurate and realistic. And as a former trader, if you've attended many events, this is a critical concept of mine. The truth is, there's many potential problems with backtesting, interpreting investment news, statistics, and strategies. Numbers can be easily manipulated, but that doesn't necessarily mean they're not valuable. You just have to evaluate the source of where they're coming from. And as we just showed with the mutual fund purchase and redemption timing, these statistics can help us, at least theoretically. So I have a few suggestions to consider when evaluating strategies. First, ask yourself if the strategy results were generated across both good and bad market environments. That's important. They'll curve fit. Ask yourself if the strategy results, if there's detailed back-tested results over long time periods on hundreds of stocks, not just on a few stocks over specific time periods. We want detail. Ask if the results have been accurately reduced by an independent third party, and if the results have been certified, and if you can get the trade-by-trade results. Now, we're not going to look at AI's technical-based stock strategies today, but this is one that we have. It's called Kinetic Conviction, and it's covered in the course. And this produced back-tested performance results on every stock in the S&P 500 over a 10-year period, and it came up with a hit rate of 82% with a 3.7 profit factor. And here's the computer-generated backtest realized equity curve for that profit factor system on the backtest. This is not hand-drawn. Again, every stock in the S&P 500 over 10 years. It didn't even flinch during COVID. It performed well over good and bad market periods. When developing your own strategies, make sure this is true. If you want the performance report showing the system parameters, hit ratios, projected returns, transaction, entry, and exit efficiencies, drawdowns, and every single trade, maybe to learn how to develop your own systems, we'll send these to you. Just contact me. We'll also send you the instruction manual so you can learn more. And just beware, some of the reports are over hundreds of pages, but we want to be completely transparent at AAII. And you should demand this if you're going to follow strategies. And lastly, yes, we had all three of our technical-based performance reports. One of them I just showed you, certified by an independent third-party company called QuantKey. Revelation 10, even with the best of intentions and exemplary research and testing, investing strategies are still about probabilities. They are not guarantees. And this has to be accepted. Successful investors accept that strategies, approaches, and methodologies are what they are, and they're not infallible. No matter how many things line up, there is never a guarantee the approach can still fail. Looking at that strategy that I just showed you, it only generated about 500 trades. That's on 500 stocks over 10 years. We were making it so strict a criteria, everything had to line up perfectly. There's pros and cons to each strategy, right? But the reason that we realize that there's no guarantee is we still need risk technique controls. And you knew this was going to come up in one of the revelations, and it's revelation number 11. Sound investing strategies focus on risk first. Buffett's 2 rules of investing, which we all know, right? Rule number 1, never lose money. Rule number 2, don't damn forget about rule number 1. Now with that, I'm going to throw you a curveball here. Although there's a definite correlation between return and perceived risk, this is a fundamental principle of finance in the investing world. In my opinion, in the mathematics, there has to be a point of balance. Why? I touched on it earlier. Inflation will significantly erode our investment returns. So be warned here, in these next few slides, I'm going to try to get you to consider higher returning investment types. if your situation supports it, and only you can determine that. Revelation 12, here we go. Although it may not be the eighth wonder of the world, and Einstein did not at least originally say this, compound interest is an extremely beneficial force for investors, with even a greater effect than we anticipate, as we saw with the example with Shane getting to $12 million on an $18,000 worth of money invested. Two well-known rules on compound interest that are at least worth a mention here. One, the more frequently the compounding, the greater the effect. And two, the longer the time period, the larger the compounding effect. Leading us to Revelation 13, start early, and investing something is certainly better than investing nothing. But to start early, look at the halfway point right here. Sorry about that, guys. Look at the halfway point after the first 18 years of contributions. At year 26, Shane only had a profit of $748,000, the profit. It's in the next 26 years that Shane accumulates 11.28 million more in profit. Unfortunately, many younger investors don't want to hear or accept this revelation, but they need to exploit their advantage while they still can. And that's why we're offering you a free EI course, presumably for a loved one who may be younger. It's critical to get people to start early and to contribute what they can, no matter how small. Revelation 14 is something that many older investors don't want to hear. Fortunately, in AI, we don't have many senior members, but I'm going to cover this revelation anyway, just to be thorough. Revelation 14, a few percentage points more of return makes a big difference in the outcome. I told you this was coming. In this table, we see that a 5% return with the parameters of our example with Shane gives a final balance of approximately $363,000. But at an 11% return, Shane got to his $12 million plus. Right there. Expanding on this, and this is a critical slide in this presentation, perhaps the most important, perhaps not, but a critical slide. Percentage return differences are not linear, and few people realize this. I'm going to repeat it. Percentage return differences are not linear due to compounding. A 3% increase, say from 2 to 5%, only nets an additional $303,000. And this questions the strategy of reaching for yield at so-called safer target amounts where many investors want to be, as it creates a supply-demand imbalance. And one has to question if adding additional risk in this area is really worth it. But as we can see, the same 3% increase in return from 11% to 14% return nets an additional $54 million. This reinforces the case for higher small cap equity portfolio weightings if you have a longer time horizon and your situation supports it. This is kind of a foundational theme with AAII. If you recall earlier from the research by Paul Merriman, he showed that small cap value stocks returned 14.4% over his research period. So this is not far-fetched, at least based on some historical measurements. Leading us to our final revelation in this section, we'll have one more at the end. And because I've been covering this side for so long, and at 29 different AAI local chapters across the country in person, most of them I've done more than once. Thank you, St. Louis this year, and Cleveland, Columbus, and Pittsburgh next year. We're not going to give you a free class in this one because many of you have seen this, but for bragging rights, if you want to type the answer in, you can. Who stated this? If I was running $1 million today, or $10 million for that matter, I'd be fully invested. Anyone who says that size doesn't matter does not hurt investing performance is selling. The highest rates of returns I ever achieved were in the 1950s. That's a clue. I killed the Dow. You ought to see the numbers, but I was investing peanuts then. For this person, he was. It's a huge structural advantage not to have a lot of money. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee it. I'm sure somebody typed this into the chat. Who stated this? Warren Buffett. Warren Buffett in a Business Week article titled The Homespun Wisdom of the Oracle of Omaha on July 5th in 1999. And for one, I'm not going to argue with Warren, right? In the EI course, we have numerous quotes from other investing legends like Fidelity's Peter Lynch, all implying and supporting our last revelation, which is important to us and the people in this webinar. Revelation 15, small individual investors have numerous and significant advantages over larger ones, and successful investors you look to exploit this advantage. This is a core belief of AAII, and it's covered extensively in the EI course. Specifically, where do smaller investors have an advantages, and how do we exploit them? Similar to our example with Shane when he was exploiting the system, a banking system that was trying to exploit him. So Shane did this by leveraging his smaller size to his advantage. After making large purchases with his 2% deposit into his brokerage firm, which we covered, he took advantage of one of the plethora of 0% credit card offers that were available at that time. He opens the new 0% card and then transferred the balance from the 2% card. At that time, there was so much competition to attract debt for those who didn't pay off their balances. Discipline again, they wanted to exploit you. There were a lot of offers with no balance transfer fees, and the offers were extended for 12 and 18-month periods. And a side note, I just checked, and these card offers still exist today, but they are not as prevalent, so you have to be more selective. With this approach, Shane still got his 2% award in his investment account, which we wanted to raise his 1 million, which turned to 12 million. But then he took the money that he would have used to pay the 2% card off and now floats it buying a 6-month and a 1-year CD that was paying over 5% at that time. When the CD expired, he took the principal, paid off the 2% card, and enjoyed a 7% risk-free return on his purchases, or he transferred and floated that a debt again when he could, targeting a 12% return. It was a simple approach where he again took advantage of a system that was looking to take advantage of him. And we're going to look to do this, the same type of thing in the investment world. Lastly, for those that say 70 years out is just too far out, Ray, consider combining techniques to create the investing capital without any changes, like the credit cards in the water, combine them, or don't stop contributing after the first 18 years. I was just in Orlando at the Big Money Show. I did a keynote and a masterclass down there. I also had the privilege of lecturing in the Money Show University to a group of college kids. And I showed them this technique. And after the event, they came up with tons of ideas how to expand this approach and how they were going to realize their goals much, much quicker. For our purposes, these techniques, as well as many others to generate money to invest, if someone's already using the credit card trick, are covered in a lot more detail in the course. Today, we only had about 25 minutes to cover 2 hours of the content. The bottom line for this section is, that you and your loved ones have the ability to create significant wealth through investing if you're willing to adapt and evolve and use a little ingenuity. Section 2 is called a wealth building evolution. Before we get to our final revelation for our story with Shane, we're going to look at 3 general areas or lessons that repeatedly surface from the various instructors now of the EI course for improving investment performance. Unfortunately, some of these are not as popular as the other revelations, but they are also the ones that, in my opinion, are going to give you that few critical extra percentage points of returns that can make a real difference down the road. So we start with another quiz and giveaway. Get ready. What asset class has been ranked #1 9 times in the 12-year period from 2013 through 2024? One asset class, we'll call it that, right? That's a clue. Which one finished #1 9 times out of 12? Give you a second, type it in. I've run this slide many times at many shows, and it's amazing how many people don't get this. AAII investors are smarter than the rest, so I'm assuming somebody will here. Okay, here's the answer. It's Bitcoin. And Bitcoin was up over 120% in 2024. It's reported now that more than 20% of Americans have some form of crypto. Now, 9 out of 12 years is impressive, but what is disappointing is that a lower percentage of older, so-called more experienced and astute investors participated as compared to younger investors. There's a lot of statistics on this. And as you know, AAII just released a new area that focuses specifically on crypto. But how could this be? How could older investors lag behind newer novice investors? The first theme of improving investment returns that was covered by many instructors in the course. Good investors are open to new opportunities, concepts, and ideas, and they evolve with the markets. We know that our markets are constantly changing for some of the reasons displayed in this slide. And this creates a lot of opportunities for smaller individual investors to exploit. But on the flip side, and there's always a flip side, some investors who are reluctant to evolve and who use the same techniques, investment vehicles, and tools that we developed literally 40 or 50 years ago are very likely at a huge disadvantage. In this section, we're going to look at a few examples to see where you are, and you can kind of test yourself on this, but evolving with the market and keeping up with education and the changes is critical. In this video, you're going to see me placing and moving in order to purchase 50 shares of the stock gold ETF GLD gold. Here's my order. You see me changing it right here. And notice what happens every time I move the order, the bids and the asks seem to be jumping. Okay, this goes on for like 7 minutes. I recorded this in a quieter time, but you can see how it's moving. Okay, that's neat, Ray, but why are you showing me this, right? Because of the markets, how they've evolved. I want to illustrate how our markets have changed and how front running and order manipulations are a real problem for our investors. And if you question this, ask yourself how brokerage firms can still make money with no commission trades. Well, they're obviously still making money because they're in business, but they're just doing it in a different manner now through order flow sales and through front running and trying to capture the spread. The markets have evolved. We would like as investors and traders to evolve with it. And here we can see an example of the matrix that I just showed you, and the bid price is right here. And here's the ask price. And they're making money off of the difference in the spread because obviously if you're looking to sell, you're going to get the lower bid price. And if you're looking to buy, you have to pay the higher price. Now, you may say, Ray, come on, this is only 9 cents, right? And you know where I'm going with this. Let's go with 5 cents. How much do you think saving only 5 cents on a single buy execution on 200 shares of stock would improve your financial situation? We won't do a quiz on this one, but for this example, we're going to say you save 5 cents on 200 shares only 35 years out at an 11% annual return. Now we're talking about a middle-aged person executing a trade. How much more money are they going to have retirement? Again, at 11% return out, just saving a nickel. Well, the answer is you'd have an additional $375 for every $10 gain on an entry or an exit transaction with these parameters due to compounding, the magic of compounding. $750 on each trade, round trip 35 years out at an 11% projected return. 10 trades, 7,500. 100 trades, 75 grand. 100 trades is not a real lot of trades, right? What's that, 4 trades a month over 2 years? That's a lot of money. We're talking hundreds of thousands of dollars because of sloppy order execution and not evolving with the market as it changes. So I want to look at this another way. We're going to do this one quick from a dividend investor's perspective. I know AAII has a lot of dividend investors. In fact, we have an entire class on dividend investing. And we show that 40% of the total return from stocks in the S&P 500 comes from dividends. If you remember in that strategy that I showed you, the kinetic strategy, that doesn't include dividends. That was just capital appreciation, believe it or not. Also, we show that over a 45 plus year time period, dividend growers outperform non-dividend paying stocks by 4.3% a year. Good again, right? Investment knowledge, dividend paying stocks, dividend growers. And this is true at times, but not all times, because sometimes dividend paying stocks is not a sound approach. It's covered in the course. But more for those aware that the volume is constantly changing, there's time to be in dividend paying stocks and there's times not to. And astute investors know this. Again, we cover it in the course. So for example, we're going to go for a dividend paying stock. Let's say a stock is trading at $10 with a 20-cent spread. Even based on a potential mid-field value of $10, which is highly unlikely if you're going to use a market order, and you shouldn't, we're going to cover this, a non-disciplined investor would theoretically be giving up 2% on the buy and sell by not using proper order execution techniques. Here, an investor could potentially be giving up the entire 2% dividend yield just on sloppy order executions. We want to evolve. The point here is that you should never use a market order, and you should learn when, the time, the day, and the time of the day, not to place orders, which types of orders to use, and at what prices and with which qualifiers. This is covered entirely in an order and execution class coming out in the course, and it's an important study. It only takes a half an hour to learn these things, and they would benefit you for your lifetime. So if not market orders, then what? Well, limit orders. Now, limit orders aren't perfect, but they are better in most cases, because with a limit order, we're telling the market the most we're willing to pay for an investment and the least we're willing to receive. We're not only going to try to save the spread, but we're also going to try the front running where we see prices move away from us. And this starts to really add up. I'm going to give you one example that's covered in the course, and it's called bracket orders. This is not a hard technique to use. Now, not many retail investors use them, but they're very powerful. And essentially all brokerage firms now have them, but they don't push them. Why? For obvious reasons, because it's their profits. And because many investors don't even know about them. So what is a bracket order? Very quickly, you can do your own research on this. With a bracket order, you're going to be able to put your profit target in and your stop loss in at the same time on a stock or ETF position. Okay? It's not one or the other. You can put both in. An example would be if I purchased a stock for $100 and I want to take a portion of profits at 120, or I want to get out if prices fall below 90, you can bracket order them, right? You can place your protection to reduce your downside risk in your profit order to lock in some gains if you get a big exponential move at the same time. They're free, they're easy to use. You just fill in a template with your desired execution prices, and you can even enter in multiple stops and multiple profit targets to scale out of your positions to lock in profits and avoid grabbing those profits too soon, which many investors have trouble with. Now, I know again what you may be thinking, Ray, I'm pretty much a mutual fund investor. So most of the things that you're covering in this section don't matter with my approach, leading to our second general theme in the EI course from the instructors on improving investment returns. Complacency, which ties in with market evolution, right? Successful investors are never complacent, and they're always looking for ways to reduce risk and or improve performance. Or better phrased with a proverb, success breeds complacency, and then unfortunately complacency will breed failure. In the next few slides, we're going to look at some ways that fund investors can be more proactive to improve returns, in addition to what I already showed you earlier. Now, this slide is from Morningstar's Ben Johnson's class on ETFs. And here we can see in his list the advantages and disadvantages of mutual funds to ETFs. And what do you see? Well, at least according to Ben, ETFs by essentially all metrics are better than mutual funds if available and appropriate. And I would agree with this. And this is especially true now that transaction costs are a thing of the past, a good evolution, and if you know ways to save the spread. Again, synergizing techniques that give us an advantage. Quiz question, here's another one. And we will do a quiz supporting a critical concept in the EI course and with our story with Shane. I showed you one earlier about linear returns. This is another critical concept. Here's the question, get ready to type. How much money would an investor theoretically end up with using the same parameters with our example with Shane if they invested with lower fee US equity-based ETFs as opposed to using higher fee equity-based mutual funds? How much more money would they end up with? The difference. Well, they use mutual funds or they use ETFs, okay? And I'm going to give you some statistics. And for this quiz, we're using data as reported by the ICI, the Investment Company Institute, for the year 2022. And they showed that the average US equity-based ETF had a fee of 0.16%, as compared to a similar mutual fund, which was at 0.44%. So type your answer in. How much more money do you think an investor would have, with our example with Shane, at the end of 70 years, if they used ETFs at the lower fee as compared to mutual funds? I gotta get some Jeopardy music here, or maybe somebody at the home office could sing. All right, are we ready? I'm going to give you the answer. Hopefully we got enough responses. Again, it's a free VES class, any class you want. Ken Fisher, Christine Benz, Paul Merriman, all great classes. Denise Chisholm from Fidelity. Here it is. Yeah, that's not the right slide, guys. I'm so sorry. Just give me 1 second. Here's the answer. We are talking about over a plus $1.5 million return difference between an investor who uses a mutual fund, you can see it right here, the total returns, these numbers are accurate, and an investor who uses an ETF at these respective fees. Of course, these fees will change going forward, but we need something. And Jennifer, the quiz, the number is actually 1.639 million in this hypothetical example. And boy, if you're fortunate enough to get a no expense fee investment, look at that difference, right? This is a lot of money by anyone's standard for such a simple investment. What did John Bogle say? Fees matter, right? Fees matter. Why stop there? We already touched on day and month timing and dollar cost averaging, but what about tax advantages with funds like tax loss harvesting, strategic holding periods, and matching appropriate fund investments to the appropriate tax deferred accounts? How about ways to deal with executions and distribution dates, which we're in that season right now, right? Then there are fund selections. These are all things that investors can learn about, including mutual fund investors. I've given you 7 or 8 techniques right now, not 20 or 25, that can really improve performance, right? There's fund selection. What metrics and areas should you look at when considering selecting a fund besides fees? All of these are covered in EI costs. And again, they can make a real difference over a lifetime. Investment education. Let me ask you this. What is better, active index, or actively managed funds? I get this question all the time. Well, according to research produced by Morningstar, they're experts in this area, the answer to them is clearly both. In this course, they showed there are 3 asset classes where active investment managers, 3 asset classes out of this list right here, where active managers routinely and consistently more than 50% of the time outperform index versions. These areas are logical, everyone should know them, and at the end of this presentation and our last quiz for a VES class, I'm going to show you them, okay? I'll tell you which ones they are. How about sector and seasonal cycles? This can also help us. In this slide, you can see slightly outdated results from CFRA on a well-known seasonal cycle, sell in May and go away. The data clearly supports this relationship that equities have historically performed better from November through April. Look at the difference. And there's several important relationships here. First, it's reflected in both average return and a number of positive return periods. The relationship existed for a fairly long time, as far back as 1945 in this study. And third, the relationship seems consistent regardless of market cap size and geographical locations. Wow, right? Knowledgeable conservative investors can use this to their advantage. One common approach is detailed in these tables. On the left, you can see the overall return by a buy and hold investor from 1945 through 2017 for the S&P 500. On the right, we can see the overall return if an investor switched to T-bills from May through October. The strategy not only outperformed, but it reduced an investor's equity risk in half, as now they're only in the market half the time. And one could say the T-bills also have a tax advantage. These strategies have merit, but can greatly enhance with more sophisticated approaches. I'm just going to touch on this. Here we can see the theoretical results of using a spread arbitrage position, exploiting contango and backwardation relationship, as opposed to going to T-bills. Look at the difference from the buy and hold approach using these seasonal cycles. This strategy is very simple to execute, but really beyond the focus of this presentation. The point here is for advanced investors, there are advanced strategies covered in the course that can also be utilized to even improve results, at least theoretically, more so. Our third lesson from the EI course for improving investment performance, and it's controversial, especially with some AAII investors. Unfortunately, adjusting asset allocations to the current market environment can be advantageous for the disciplined, educated investor. And this could be something as simple as shifting allocations to or from money market instruments or CDs. I think most investors would agree that it really didn't make sense to hold one-year CDs when rates were below 0.5% from 2011 through 2017. Call it investing timing if you want, but at times it just plain makes sense, especially with our new transparent Fed telling you what they're intending to do. They don't want to shock the market. We see this in housing prices trends with projected interest rate directions, etc. It may not be market timing, but at times is a good place to be and maybe not so good place to be. Now, investment allocation or market timing isn't always about beating markets, as sometimes it's about controlling risk. And here we have a very simple and popular technical timing strategy called golden crosses and death crosses. And you can look this up. But a golden cross buy occurs when the 50-period moving average crosses over 200, and a death cross occurs when the 50-period average crosses down under the 200. And you can see these right here on the S&P 500. This strategy's main goal is to try to avoid large drops while maintaining a position in the market the majority of the time because the market's upward overall bias, but where they don't want to lose a lot of money because they can't tolerate a big 40% drop if you're older. Is it effective for controlling risk? Yes. For outperforming the market, less so. If you followed this strategy during the dot-com crash, you would have gotten out 9.1% lower, and you would have gotten back in right over here. You would have gained 31% of the market. Again, you're not looking to beat the market, you're looking to avoid large drops. During the Great Recession from 2008 to 2009, you would have gotten out 6.4% down, very good. You would not have gotten at the very bottom, but you would have gained 30%, 6% in the market with a lot less stress and pain. COVID crash was not normal. The market rebounded quickly because of the Fed, but you still would have gained some and you would have missed out on some of the pain. Anyway, you can set this strategy up for free on the internet. You only have to check it a few months. With this strategy over the last 15 years, it only generated 3 signals that got you out and did not get you better in at a better price. And these signals are very rare. They only happen once a year, or once a year, or twice, once every 2 years. Think about that though. Over 15 years, AAII has a tool coming out, and this tool is included free for anyone who completes the EI course for this purpose. This tool projects the future price needed at any moment to generate a change from a death cross to a golden cross. And I should add, we're going to be posting these signals every week on AAII's Active Investing webpage. Okay, AAII's Active Investing webpage. I do want to mention that for more active investors and those who are interested in tactical trading, AAII has a new area coming out called AAII's Active Investing, and it should be released in the next few months. This is definitely for more hands-on investors who are interested in investing in multiple areas: stocks, bonds, ETF, crypto, commodities, VIX, and they're interested in using a variety of techniques like hedging, tactical timing models, spreads, and various option strategies, covered calls, and crash secure puts. I just want to make you aware of this. Here's our last section. It's about 4 minutes long. Keys to improving investment performance. Here we'll recap the main themes in the presentations. We'll give you the final revelation, and we'll provide you the information for the free offers. We'll also announce today's Whiz Quiz winners, and who get any free class. And with Jenna's help, we can all take a few questions. Quick recap here. For most people, investing is a necessary and realistic option to achieve true financial freedom. To be a successful investor, you must not only have knowledge, but current knowledge. Popular or not, what worked yesterday is really the most efficient approach for today. Successful investors acknowledge that our markets are constantly evolving, and they evolve with them, and they look to take advantage of and exploit new opportunities by using their investment knowledge. Successful investors also realize that small increases in return due to compounding or savings, of course, can make a dramatic difference in their overall performance over a lifetime, as we showed today. Successful investors know how to create a plan that's right for them, not my plan, not somebody else's, the plan that's right for you, and that have the discipline to follow that plan, and that they tend to focus on risk, controlling what they can and accepting what they can. Lastly, as I hopefully shown, investing knowledge is one of the foundational elements to be successful, but there are two others. First, it's critical to not only attain the knowledge, but then how about apply and take action, right? I told you we'd end with a quote here, put much more eloquently from one of the smartest men to ever live, right? Knowing is not enough. We must apply. Willing is not enough. We must do. Leading to our final revelation, without this one, knowledge, action, and without Revelation 16, none of these really matter. The building of wealth through investing is possible for the vast majority of individual investors. Without the belief, people won't even try. The quote from Henry Ford. To be a successful investor does not necessarily take a special skill set, sophisticated strategies, lots of money, lots of expensive equipment, or complicated software. But it does take knowledge to develop sound, modern investing approaches, develop a plan or a set of strategies that's right for them and that works in today's environment. There's very few downside to gaining knowledge, and that's what the EAI course focuses on. Evidence-backed strategies that can be used by all types of investors with all types of investment types and all different types of approaches. I've touched on a few of these today. For this, AAII put together the offer. Jenna will give you the details about that. So I'm not going to touch on this. Jenna will. I'm going to give you our final quiz. Oh, I should mention this, though, that it really is a great holiday gift, and it can really make a big difference in somebody's life, especially if you have children or grandchildren. And a real quick story here, I know they would prefer that trip to Aruba, but tell them once they complete the EI course, then you give them the trip to Aruba. And the only reason I tell that story is I literally had a friend who did that. Daughter showed no interest, took the course, loved it, changed her life, and then she got the trip to Aruba that she wanted from her mother. That's a true story. Here's the details. I will let Jenna go through, but we will let whoever you give a gift to know around December 20th. We'll give them an email, send them an email with the credentials acknowledging that you sent them the gift. If you want to learn more about the EI course, you can go to www.aai.com/learn. Okay, and there, I'm not going to test you on this URL. Don't worry, that's not the final quiz. And we have dozens of documents and videos, if you still want to look at it. Remember, you have 60 days to look at it. As promised, our last giveaway, I think this is a one slide left, for a free VES class. The first person to type in 2 of the correct 3 categories where active fund success rates are better than passive funds will win. There's the list right there. You have to select from those. You can just type in 3 categories from the list on the left in the red box. Just do it on the same line though, okay, and separate it by a comma. So it'd be like US large blend, comma, mid-cap growth, comma, Europe stock. And if you get 2 out of the 3, first person to get 2 out of 3 will win. And I'm going to give you a hint. None of those are the ones, okay? I'm going to give you another hint as you're typing, so you may want to stop. None of them are in the top half of this table. So they're all from the bottom half of this table. The course really is a great course. I'm just feeling some time here to give you a chance. I don't know how many people have taken it. It's been available for a couple of years now. Certainly hundreds and hundreds and hundreds of people have taken it. And the tools really are a major benefit. I don't know many courses that give you advanced tools really built by a group of people at MIT to help in this manner. Okay, here we go. Jenna, hopefully you have enough. If not, then pick the person who gets the first ones. The correct answers are, drum roll, there they are, high yield bonds, global real estate, and diversified emerging markets. US small cap growth was right at 50%, supporting AI's position that this is a good area for small individual investors to look at. But what do you see here? Look right here. Notice how the outperformers only happened in the lowest cost funds, not in the highest cost funds, reinforcing again a central theme. Educated investors have an advantage. My sincerest hope is that you learn something in this presentation that will help you improve your investment performance and, more importantly, propel you to keep learning and expanding your investment knowledge. I can't emphasize this enough. There are few things in life that can bring so much potential benefit to somebody that requires so little effort. I started with a quote. I guess I'm going to end with another quote. The most important investment one can make is investing in themselves, or perhaps in your loved ones, right? My name is Raymond Rondeau. I'm an investment strategist with AAII and the director of AAII's Active Investing, the completely new area of AAII focused for hands-on investors. Be sure to check it out in a few months. We're going to do all types of strategies like this. Jenna and John, I'm going to return control back to you guys to announce our quiz winners, provide more information on the EI course, in the monitor, and address any questions about today's presentation content. Thank you all for your time.
Thank you so much, Ray. Great presentation, Jenna. Before we start answering questions, anything you want to, information you want to provide to the people who are listening in today?
Yes, of course. So a couple things. So I kept putting a lot of the good resources, links, and everything in the questions panel. And so you'll have all the links and everything. We're also going to include all of those links in the email that we send to all attendees later this week. So you'll have them again, easy to access. But just like Ray had mentioned, that you have, if you purchase an EI course using the link AAII.com/VES education/holiday before December 14th, you'll get to take advantage of our BOGO deal. So you'll buy one and then be able to give one to any person of your choosing. Simply purchase it via the link and then email members@AAII.com with your gift recipient's information so that we can give that to the said person. So of course, all that information will be in those emails, or in that email that you'll receive later this week. If you have any questions at all, please feel free to reach out to us, members@AAII.com. Happy to help any way that we can. And I got a couple other things, but we'll wait until after the Q&A to kind of wrap those up, and I'll let everybody know when about the recording, handouts, all that good stuff. But I did want to announce our winners. So for winner of question number 1, we have Tim Land. Winner of question number 2 is Andre Ziegler. Unfortunately, we didn't have a winner for question number 3. Ray actually stumped the audience. He threw a curveball and
No one
didn't see
was even
any
close to
winners.
crypto.
No one was close. A lot of
Oh,
good answers, but no close, but no cigar. Winner of question number 4 was T Hart, and winner of question number 5 is Ken Kuhn. So we will reach out to those who were our winners today in the next few days. Just look out for an email, and Ray has mentioned that you have won a free VES class of your choosing. So go ahead and visit AAII.com/VES, and then you can take a look to see what kinds of classes are offered, and you can pick one.
I think the curveball in question 3 is, and I understand your pain, is asset class. Is it really an asset class? You know, and I think that's what shows people. I just ran the slide at the Money Show, and a lot of people didn't get it either.
Wonderful. Well, I've got a couple questions here from people who are participating, and if you have any additional questions, just feel free to type them into the questions area. Ray, since knowing when to sell is almost harder than knowing when to buy, are there any specific indicators or tools you like to use to help determine sell points?
Yeah, absolutely. I mean, that's a great question. If you've attended one of my events, maybe in the last 4 or 5 years, I go in and I really focus on technical analysis and timing strategies and chart reading on when to sell, because everybody wants to buy, right? And you know, there's an old adage: you buy on the fundamentals, but then you look to sell on the technicals, or at least start to scale profits out or risk control. So that's a somewhat loaded question. If you're following a sound-based strategy like I showed, then these are all computer generated, you know, and they're already figuring out where to get out and where to get in, and you're using that information. If you want to use pure chart reading, then I would say support and resistance is probably your best area to look at right there. Use support and resistance. Try to look at what the rest of the market is looking at, that self-fulfilling prophecy. When you think everybody else is going to get out, that's when you look to get out. That's a real quick answer. You can use indicators also, such as RSI, and AAII has some new indicators that are coming out that are much better than Bollinger Bands, stochastics, Williams percent. We have the data to prove it, and that does generate simple buy-sell signals.
And I guess the key, as what you stated there, is basically, you know, whenever you're buying a security or an asset, you really want to know what's going to make you sell it right then and there. So you want that disciplined system in place so that you're not, you know, you're not basically self-guessing, or you're not letting your emotions do the best of you as far as that's concerned. So this is an interesting question. I'm not sure how to answer this, but that's why you're here.
I don't want to say
you gave a lot of great examples of how someone younger can grow wealth, and the importance of compounding, how little rates of return differences can make a big difference. But this gentleman, you know, I'm an old retired person, but with an avid interest in growing what I have even more. You know, how would I use this information for that purpose?
Well, it was on a question that you all missed, right? Because crypto was up 120% last year, Bitcoin. I'm just, if you're, and I'm assuming, sir or ma'am, I'm assuming you're an advanced investor. You've probably been doing this a long time. If you are very disciplined, and if you have strategies that are back tested, that you're comfortable with, etc., you use them for a long time, then in that case, the answer probably comes down to, if you're comfortable with it, shifting to derivative markets and using the leverage of options, right? If you know your system works and you're confident you're going to hit 80% of the time, or whatever your system is, then you could start to use there and really accelerate. And again, you can only lose what you're purchasing, right, for the option. So you have a lot of downside protection there. But then it gives you greater upside potential if your system works.
And I guess Michael Levine was wondering, you know, you gave an example of how you can use a 50-day versus a 200-day moving average to take longer-term trend decisions as far as moving in and out of the market. He noted that, you know, would potentially shorter-term moving averages or exponential moving averages be even better techniques to use. Any observations or comments?
Well, that strategy I showed, it's for older investors who want to stay in the market the majority of the time for the upward bias, but they just can't take the 40 or 50% hit. That's one strategy I showed. Certainly, there's numerous strategies that are certainly better for shorter term timing. I mean, literally, right, you can do day trade, swing trade, position trading. I like that 3 to 6 months period. But for that, the mistake there is, and I can show this quantitatively, is investors or investors fail to evolve with the markets. They want to use a single indicator based on one measurement or a principle, such as like Bollinger Bands, based on volatility or something. And it's clear that the combining of multiple established factors into one indicator is a much better way to do that. And then you can contour and optimize these down to, I want a week timing model, I want a 30-day or a 60-day or a 90-day timing model. And that's what AAI's investment tools that we're talking about really focuses on. And again, we give you the information. Did that answer that, John?
Yeah, it does. Very, very good. I guess this is probably a tougher question to answer, but how would you fold social values into the quantitative investment techniques that you were just demonstrating? You know, for example, say you were particularly wanted to focus in on companies in more sustainable or green industries. How would that be included in the modeling or the process of investing?
And I respect that question, and I respect that person's viewpoint. It's important. I would just say that that's probably better answered by yourself. My techniques, and again, please remember, I have a trader's background. I'm an MIT engineer, but I have a trader's background. My techniques, I don't factor them in. I'm in the market for one reason, and it's to control risk and try to extract as much money as I can. I don't try to bring social values in, but that doesn't mean that you shouldn't. Okay, that's just not my area. So I do not try to limit myself in any area. So I don't. But maybe John, you could answer that more.
Well, I think of as perhaps in some of your techniques can be used to help determine entry or exit points for specific stocks. So I guess in that context, I guess if you were to pre-filter what companies, ETFs, or sectors you want to invest in, you could then use these technical tools to help determine which tools, industries that you support are positioned to do well or poorly, depending upon your entry exit. The only way I could think of is do your filtering in advance and limit your universe to those you want to then do additional analytics on. That's perhaps the only thing I could think of as far as a way to kind of combine the two.
Yeah, I mean, there's no doubt, right, that sectors and industries have a huge component on the overall performance of each individual stock. So I would agree with you. I kind of interpreted the question maybe from a social, like, I want to support this type of energy as opposed to that. Yeah, and I just tend to go where I think the best potential to make money is. And maybe that's sense. I'm being honest.
I don't know. I guess I have no more questions, I guess, in terms of strategies that I come up, but I have one question, I guess, from a member who, if I send an email to my children to see if any are interested, can I wait a few days to order the course for me and hopefully different children? So I guess how long is this offer good for? I guess is I get perhaps a different way of phrasing that question, I guess, or Jenna.
Correct. No, that's great. Absolutely, you're able to wait a few days. The offer is good through December 14th. So if you, as long as you can get, we gave about a week and a half to get those, to be able to purchase and everything. So talk with your kids, and you'll have till December 14th.
And I guess one last question just popped up. These technical tools you are referring to, are those taught or available in EI course, or are they by being a member of AAII?
I'm sorry, John. Could you repeat that just quickly?
Yeah, I'd be happy to. So I guess you mentioned a number of tools that are going to be made available as part of active investing. So are lessons provided on how to use those tools in the course, or what's the best way to find out about these technical tools?
Yeah, we'll be having a lot of information coming out on that, but there'll be classes with each technical tool, so you understand the theory, the reasoning, how to interpret it, the applications. We'll give you the data to show the efficacy of the tool. So yes, absolutely. We have manuals for each tool. In truth, it tends to be overkill. Most people just like the single sheet. Tell me what it does, what I'm looking for, 2 or 3 things with each tool. Most people like that, but we give very in-depth knowledge if you want it.
Very good. Well, that's all the questions I see as far as overall techniques or analytics. A lot of people were just complimenting you on a great presentation, found it very informative, and thank you so much for listening in. Jenna and Ray, please take it away.
Yes. Well, I want to give Ray one last, chance to, if you have any last minute thoughts that you want to share with the audience. But I want to also thank you and, John, for really guiding us through the EI course and the type, previewing the type of content that is featured. So Ray, do you have any last thoughts or anything that you want to leave the audience with?
We'll just leave one. I mean, for most investors here, they've seen what it is and the tools, and they have a pretty good idea what the cost is. The one thing I will say is I did that Money Show University in Orlando a few weeks ago, and there was like 6 speakers. They were all big Charles Payne. They were all TV personalities. They kind of threw me in there, and I did very similar to this. And they even had one on crypto. And I have to be honest with you, at least based on the ratings and stuff, it really hit home with younger investors. I really do believe that small sacrifice, and we're talking millions of dollars, and I do think that it does move the needle with some younger investors if you can get them to get their attention to look at it. That's all I would say.
That's excellent. And I just want to thank you, Ray and John, for today's event. And then also I want to reiterate that as far as the winners from today's interactive quizzes, we'll reach out to those via email in the next few days. So please keep an eye out on your inbox from an email for us. And then if you have any questions about the EI course, including the content, platform, certification, pricing, anything else, feel free to email us at members@AAII.com. Or you can call 708-742-8774 Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then as a reminder, all attendees can get the exclusive holiday discount and BOGO deal by visiting AAII.com/VES-education/holiday. And then just remember to contact member services by email or phone after you purchase to provide them with your recipient's information so that they can give access. And that is for the EI course. That's the buy one, get one deal. And this presentation was recorded and a replay will be available at AAII.com/webinars, as well as on our YouTube channel. And then webinar attendees will receive an email with the link and then in the next few days. You'll also receive a copy of Ray's presentation slides, as well as links to other resources that we find helpful or anything that we discussed today. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you so much and take care.
Thank you. Take care.